Good morning. Today we are initiating a deep dive quantitative analysis on Adyen NV, ticker ADYNE, listed on Euronext Amsterdam. As a senior equity analyst, I approach this coverage with a focus on long-term free cash flow generation and the company's unique position within the global payments value chain. Adyen represents a distinct asset in the fintech coverage universe, often characterized as the premium option due to its single-platform architecture versus the patchwork M&A strategies of its competitors. In this report, we will dissect the validity of its valuation premium, analyze the trajectory of its EBITDA margins following the recent capitalization cycle, and determine if the current multiple compression offers an attractive entry point for institutional capital. We are looking beyond the hype to the core unit economics. To understand the valuation, we must first understand the moat. Adyen's primary competitive advantage is unified commerce. Unlike legacy incumbents such as FIS or Fiserv, or even modern competitors like PayPal's Braintree, which grew through acquisition, Adyen was built on a single codebase. They do not rely on third-party gateways or disparate acquiring banks. They are the gateway, the risk management engine, and the acquirer, all in one. For the institutional investor, this translates to zero technical debt and superior operating leverage. Every dollar of revenue scaling requires less incremental OpEx compared to peers managing Frankenstein's legacy systems. This architecture allows for higher authorization rates, which is the single most critical KPI for their enterprise merchant base. Let's look at the hard numbers. We are tracking total processed volume, or TPV. Adyen has historically delivered TPV growth in the mid to high double digits. However, the market is currently pricing in a deceleration as the law of large numbers takes effect. Our models focus on net revenue, which is gross revenue minus financial institution costs. We are observing a net revenue CAGR of approximately 20 to 25% projected over the next 3 years. Crucially, investors must monitor the regional mix. North America has become their fastest growing region, recently surpassing EMEA in contribution for certain quarters. This geographic diversification is vital as the European market matures. We are looking for sustained volume growth above 20% to justify current multiples. A critical input for our DCF model is the take rate, the percentage of transaction volume Adyen retains as revenue. Adyen operates on an interchange plus-plus pricing model, which is transparent but leads to lower take rates compared to blended pricing models like Stripe or Square. We are seeing a gradual compression in the take rate, currently hovering around 17 to 18 basis points. This compression is not necessarily negative. It is a feature of their strategy to land whales, massive enterprise clients like Uber, Spotify, and McDonald's. These merchants command volume discounts. The bear thesis suggests take rates could erode too quickly. However, our analysis suggests that the absolute gross profit dollars per merchant continue to rise due to volume scaling. Volume growth is outpacing rate compression. This slide addresses the volatility we saw in late 2023. Adyen management broke with the tech sector trend. While others were firing, Adyen was hiring aggressively, causing EBITDA margins to plummet from the mid-60s to the low 40s. This terrified the street. However, the investment phase has now normalized. Management has reiterated their long-term guidance of EBITDA margins returning to levels above 50%. This creates a textbook operating leverage setup. As the hiring slows and the new cohort of engineers and sales staff becomes productive, revenue should grow significantly faster than OpEx. We are forecasting a margin expansion trajectory starting in H2 of this fiscal year, which is a key catalyst for stock price recovery. Adyen does not compete for the coffee shop on the corner. That is Square's territory. Adyen competes for the Fortune 500. Their primary rivals are Stripe in the digital-first space, PayPal's Braintree, and Checkout.com. In the physical point-of-sale (POS) world, they disrupt incumbents like WorldPay. Adyen's competitive edge lies in unified commerce, the ability to view online and offline data in a single dashboard. For a retailer like H&M or Nike, this data is invaluable for loyalty programs and inventory management. While Stripe is formidable, Adyen's direct banking license in Europe and the US allows them to bypass third parties, offering superior reliability and settlement speeds. This infrastructure advantage is the primary defender of their premium valuation. Valuation. Adyen has never been cheap by traditional value investing standards. It trades at a significant premium to the broader payment sector. Currently, we are looking at a forward PE ratio that often fluctuates between 30x and 50x, and an EV to EBITDA multiple in the 25x to 35x range. You are paying for certainty of execution and growth quality. When we compare this to PayPal, which trades at a low teen multiple, the delta is massive. However, PayPal is battling slowing growth and identity crises. A better comparison is MasterCard or Visa, which trade at high premiums due to their duopoly modes. If Adyen can sustain 20% plus compounding growth, the PEG ratio, price/earnings to growth, begins to look attractive for a long-duration hold.
We must rigorously test the downside. The bear case for Adyen revolves around the commoditization of payment processing. In North America, the market is fiercely competitive. If Braintree and Stripe decide to engage in an aggressive price war to win market share, Adyen's take rate could compress faster than their volume grows. Furthermore, the macroeconomic environment poses a risk. A global recession reduces consumer discretionary spending, directly impacting TPV. Since Adyen's revenue is transactional, they are not immune to a retail slowdown. Finally, there is the risk of disintermediation. Though less likely, large merchants could theoretically build in-house solutions, though the technical barrier remains high. Conversely, the bull case offers significant upside optionality. Beyond standard payments, Adyen is expanding into platforms and embedded financial products. This means offering bank accounts, capital, lending, and card issuing to their merchants' users. Think of an eBay seller getting an Adyen-issued debit card. This shifts Adyen from a payment processor to a comprehensive treasury bank for platforms. If they successfully execute this, the total addressable market expands exponentially. Additionally, if the North American push succeeds without destroying margins, Adyen cements itself as the global standard, creating a network effect where multinational corporations refuse to use any other provider due to integration standardization. In conclusion, Adyen represents a high-quality compounder trading at a premium that requires patience. We view the recent multiple reset as a healthy rationalization of the stock. For the institutional portfolio, Adyen serves as a core fintech holding, offering exposure to the secular shift to digital payments without the credit risk of a lender or the legacy drag of a traditional bank. We maintain a constructive outlook, contingent on the delivery of the promised EBITDA margin recovery in the coming quarters. Volatility is expected, but the fundamental unit economics remain best in class. We rate this as a long-term accumulation play on dips.